Welcome everyone to another installment of Record Time. So today we'll be doing a very important chapter which is covering valuations. Within valuations, we'll be talking about how we conduct valuations, the different models they are, as well as looking at the concept of control premiums and minority discounts. Hopefully, by the end of this video, you'll be having a theoretical understanding and a foundation of valuation so that you can do the practical side of things. Before we proceed, I'd like to remind everyone to please remember to subscribe to the channel and grow our community. Also remember to like and comment at the end of the video. And that is important because we're able to have traction. And this traction is important so that our video becomes recommended on the YouTube algorithm. And therefore we're able to reach a wider audience. So please like and comment at the end. Okay, cool. So let's go straight into it. Now, today, as we mentioned, we'll be talking about valuations. Now, within valuations, the first question that you should be asking is, why would someone want to do a valuation? Right. Now, fundamentally, valuations are conducted so that you can determine the value of something. Now, this something could be an instrument. For example, preference shares, debentures, bonds. It could be a project. Usually, when we talk about projects, this is capital budgeting, or it could be a company. Now, in this video, we'll be looking specifically at companies, right? That's the focus of today's session. Is what do we do when we want to value a company? Now, why would a person conducting a valuation want to understand the value of a company? For you to understand this, you need to understand that the core of any valuation is to assist someone to make decisions. Now, when we're trying to determine the value of a company, we want to make certain decisions. Now, these decisions are broad, but we get two main decisions. Right? The first decision is the investment decision. Now, we want to decide whether we should buy the company, sell the shares in the company. And those are the main two decisions that we typically make. Now, how would we go about deciding whether we should buy the shares of a company or sell them? Right. Now, assume that we've conducted a valuation, right? And we've determined that the value of a company on a per share basis is 15 Rand. Now, assume further that the share price of the company is currently trading at 10 Rand. Now, very important, we've conducted our own independent valuation, which has told us that the company is worth 15 Rand per share. However, if we look at the market is saying the share is worth 10 Rand. Now, what does this mean from a decision-making point of view? If you guess it correct, it means that we should buy the share. Why are we saying this? Right. So, if we buy this share, we will have to spend 10 Rand. This will be an outflow. Now, what you must understand that from a finance point of view, we believe that the value of a company, right, is what the market will price in the future. So, all else equal, the main concept around valuation is that the share price, which is the price that the share is trading at today, will in the future equal its value. So in the short term, we might have mismatches between the value and the share price. Why? Because of a variety of reasons. For example, the share price of a company might reduce because of negative media attention, could be that we're downsizing or entering into a new uncertain project that the market is uncertain about. So there are a lot of factors that could drive the share price to change in the short term. However, in the long term, the fundamentals of a company will always return to its true intrinsic value. And that's why we conduct evaluation. So if we assume that the share price will then return to in the long run to its value, then today we'll buy it at 10 rand. Then in the future, the share price will be sitting at 15 rand. So that means that we would have made a profit in the future of 15 minus 10 of 5 rand per share. So naturally, that's why this is a good thing. And therefore, we should have bought the share. So that's this is the main thing that we use valuation for. When we conduct a valuation and we determine that actually the value of the company is underpriced. So we then have an opportunity to buy so that in the future, if all else holds equal, then we can potentially profit from that. So that's the first scenario. Right. What about the second scenario, which you talk about selling? So let's mix it up. So if we had a situation now and we said that actually the share price is actually worth 10 rand again, but now our valuation tells us that the company is actually worth 5 rand. Now, what did we do here? Then, in this case, because I don't have any shares in this company, I won't do anything at all. So I do nothing. So in this case, because of the fact that I currently believe these shares are underpriced, or overpriced in this case because the share price is higher than value, I'll then decide not to buy these shares. Why? Because if I were to buy these shares today, right, I'd have an outflow of 10 Rand. Now, assuming that the share price will return to its true intrinsic value in the future, then in the future, the share will be worth 5 Rand. Then, relatively speaking, it's minus 10 plus 5. Then I've made a loss of minus 5, which is a problem. That means I've eroded value. However, it's very important to understand that if I held the shares already, so assuming that I already have the shares, then this might be a strong indicator to sell, right? Because I know that the share price will go down, so therefore I want to lock in my profits now. So a person would want to lock in their profits now so that their profits don't decline in the future as the share price moves with intrinsic value. So these are some of the important considerations when determining valuations that, as you can see, we're able to determine mismatches and decide either to buy or sell depending on whether the value is high. If the value is higher, then we will buy. If the value is less than the share price, then we will consider selling. Okay. The second decision that valuations assist us with is that they help us determine the price to pay. Now, in the future lectures, you'll probably encounter what we call mergers and acquisitions. Now, in mergers and acquisitions, the main principle here is determining how much I should pay in order to buy shares in a specific target company. Now, in determining how much I should pay, the center of this is the value of the company. Why am I saying this? Let's say I'm a seller, right? And I'm the seller and I own 100% of company B, right? So I'm a seller and I own 100% of company B. Now I want to potentially sell this company. If I determine that the value per share of the company is sitting at 100 Rand, right? So you agree with me that the person holding these shares at a minimum will want a price of 100 Rand, right? So the minimum price that they will demand is at least 100 Rand. So any buyer, any potential buyer coming to buy this company has to, at the very least, compensate the seller for the value of the company, which is 100 Rand. If the price that is being posed to buy the company is less than 100 Rand, it's more likely that the seller will reject that offer. If the price is above the minimum price of 100 Rand, it's more likely that the seller may accept that offer. So, as you can see, valuations play a crucial role in this negotiation process in terms of what price to pay within a merger and acquisition deal. So that's the second application. And these are the two main applications from your perspective that you need to know in terms of why valuations are important. Okay. Now that we know why valuations are important, i.e., they're important in terms of making decisions, investment decisions specifically on whether to buy or sell, and they're also important in determining or being able to negotiate the price to pay for a specific company, we then have to look at the next section, which deals with how you go about doing the valuation. Now, as we look at how to do valuations, what you need to understand, valuations can be conducted from a variety of different perspectives. Valuations can be done from a mathematical perspective, right? Usually our friends doing corporate finance, from a maths perspective, able to conduct valuation using those principles. It can also be done from a behavioral point of view. Sometimes we use psychology principles here. We can use psychology principles or concepts about behavioral in order to determine the value of a company. However, from our perspective, and the most common one that we will be looking at in this series is that we're looking at from an accounting point of view. And that's really where our focus will be, is how do we conduct valuations from an accounting point of view? Given that we'll be conducting valuation from an accounting point of view, it then follows that the key for us in doing valuations is to be comfortable with the financial statements of a company. Recall, the financial statements of a company provide a broad outline of how, from an accounting perspective, the company was doing. And therefore, it makes sense that when we conduct valuation from an accounting point of view, the fundamental bedrock will be financial statements, or at least financial statement related items. Okay. So now let's look at a deeper dive into how we conduct valuations from an accounting point of view. Right. As you'll recall from your accounting lectures and from your fundamental introductory lessons in accounting, that we've got an accounting equation. And this accounting equation is crucial when we conduct valuations. That is, assets equals owner's equity plus liabilities. Now, what is important is that when you're doing a valuation, you're basically valuing ordinary equity of a company, right? So when we talk about the ordinary equity of a company, this is the same as saying, what is the company value, right? And that's a very important concept to understand. The company value is equal to the ordinary equity of a company. So if we flip the switch of this equation, we can say owner's equity equals assets minus liabilities, right? So if we take the assets of a company, we subtract the liabilities, we should be able to derive the ordinary equity and therefore the company value. Now, the second concept you need to understand is that valuations are conducted based on a market or future approach. So think about a valuation as looking at a crystal ball into the future, trying to establish what the company will be worth in the future. Therefore, it's important that if I want to understand what the value of the company will be today, I need to consider future looking information, forward looking information in baking in my decision. This is why we focus on market and future approach in determining the value of a company. So how does this concept then tie back into the accounting equation? This means if I want the ordinary equity of a company, i.e. the company value, I must then take my assets, fair valued, then I subtract my liabilities, fair value. So this means in an ideal world, in an ideal situation, if I wanted to determine the value of a company, all I'd have to do is to pick up its balance sheet or statement of financial position, then determine the fair value of each and every individual asset and subtract the fair value of each and every individual liability. If I do that, then you determine the ordinary equity or the company value of a company. So now this looks like a simple exercise to say determine the assets at fair value, subtract the liabilities at fair values, then you'll get owner's equity. However, how practical is this? Right? In reality, determining the fair value of assets, for example, is difficult, right? Sometimes, or most of the times, assets work together in order to generate future cash flows. For example, you get business going, you might need your plant, which manufactures. However, from your plant, you then have stock. Then that stock you then sell off. So can you see there's an integration between the plant, the stock that you're selling, and the revenue that you're generating. You can't generate revenue from one asset only. You need multiple assets working together in order to generate future cash flows that increase the value. So because of this high integration in terms of how assets work, and also because of the uncertainty, right, of cash flows, which are very difficult to determine. It's very difficult to determine that if I buy an asset, these are the future cash flows, because ultimately you then have to use the asset, and after using the asset, then you generate revenue, and that revenue is really subjective. It can be driven by what the economy is doing. It can be driven by interest rates or other factors. So because there are so many factors that drive the cash flows that you're going to generate from these assets, from the economy to interest and other factors that are not in the control of a business, it then becomes difficult to conduct a reliable, fair value determination of each and every asset sitting in the business of a company. And it's because of this inherent difficulty that we then develop models. And these are the models that we will be covering now, which assist in determining the ordinary equity of a company. Right. So let's look at some of these models that have been designed in order to assist the valuation of companies given these complexities. Now, there are different valuation models that we typically come across, right? But these valuation models can be defined into two broad categories. We get valuation models that follow the income approach. Then, then we get valuation models that follow the market approach. Now, models that use the income approach typically look at future cash flows. So the concept become income approach is that I take future cash flows, and this could vary. And these future cash flows are typically then discounted at a rate which typically compensates investors for their required return. So we take future cash flows, we discount it at an appropriate rate that compensates those providers of capital or those investors with the required return necessary from those cash flows. Right. And then once we do that, we then are able to determine a present value, which then we can then use to determine the value of a company. So that's the main sort of concept of income approaches. Market approaches, in contrast, market information, right? And the market information can be twofold. Firstly, you can simply look at the share price of a company, and therefore this share price of a company can be viewed as a proxy for the value. Alternatively, you can look at ratios. Now, what ratios do is that you look at comparable companies and comparable market ratios. For example, your PE ratio, right? And you basically look at that PE ratio and you multiply it by some type of maintainable earnings. And then that's a basis for you to determine the value of a company. Now, we've looked at these different approaches, income approaches and market approaches. Now let's look at specifically what we see within each one. Right. The purpose of this video is not to go deep into these approaches. We'll look at them at a later stage in the next video. But for now, what are some of the examples of income approach models and what are some examples of market approach models? Right. So income approach models can involve the dividend growth model. Now, again, purpose of this video is not to go deep into this, but is to understand here the concept of a dividend growth model is that we take future cash flows. In this case, our future cash flows will be dividend. Then we discount those at the cost of equity, and therefore we're able to determine the value of a company that way. The second one is what we call the free cash flow to the firm approach. So the free cash flow to the firm approach takes your net operating after tax cash flows. So your future cash flows here deemed to be your net operating profit after tax. Then you subtract your net investment changes in working capital and net investment in capital expenditure, and then you discount that at the cost of capital or your WACC. And that is a proxy in that case of determining the value of a company. The third approach that we use is the free cash flow to equity. The free cash flow to equity is similar to the free cash flow to firm. The only difference here is that we include financing cash flows within the future cash flows and therefore discount at the cost of equity in order to determine the value of a company. Now, market approaches, some examples of market approaches could be your market capitalization. So your market capitalization is basically the share price multiplied by the number of outstanding shares, as well as relative valuations, right? Which basically look at a comparable ratio of an industry or a sector and multiply it by the maintainable earnings of an entity in order to get the value of a company. Now, we will cover these in more detail in part two. So please go to when you're done with the fundamentals and have understood the concept of a basic valuation from this video, then go to part two where we go deeper into these different valuation models and how they work. But for now, it's important for you to understand the difference between income and market approaches. Right. Now that we know the difference, right, the next concept is understanding what we mean by minority models versus majority models. Now, this is a very important concept because sometimes in a test and exam, you're asked to value a 60% stake or 80% stake or 5% stake. However, you're giving information that is designed to guide you to focus into a specific valuation model. The question becomes, does that valuation model become appropriate based on what you're trying to value? And for you to be able to understand this, you need to understand the outcome of what you get from a specific valuation model versus what you were trying to achieve in terms of from a theoretical point of view. Now, right. So what do we mean by a minority and a majority model, right? So minority models tend to focus on minority interest. So what do we mean by minority interest? If you are minority shareholders, first of all, you typically have less than 50% of the shares in a company, right? That's the first thing you need to understand. Now, if you have less than 50% of the shares of a company, what are some of the things that you typically focus on in terms of your investment as a shareholder? Right, that's correct. You'll typically focus on the share price. You'll also focus on any potential dividends. So these are the major income streams for minority shareholders, share price and dividends, right? Specifically within the share price, you're looking at appreciation. So for example, if you buy a share for 5 Rand, then in 10 years' time, that share is worth 50 Rand. You've made a profit of 45 Rand. That's what we mean by capital appreciation, right? And typically, this is the main focus of minority shareholders. They're looking at how the share price is fluctuating and moving. Similarly, if you're a minority holder, you are able to obtain dividends. Now, dividends are basically outflows or cash inflows that you get as a shareholder by virtue of owning stock in a company. So either every year or biannually or quarterly, can declare dividends and basically return some of the value of the company back to its shareholders. And that's an income stream that you as a shareholder who has a minority interest will be looking at. So how does your focus as a minority holder on share prices and dividends then factor into the different valuation models, right? So all this means if your valuation model focuses either on the share price or market information, or focuses on some type of cash flow that is related to dividends, then we'll typically call that a minority model. So what are examples of minority models, right? Example of this would be a relative valuation that focus on price ratio. So if my relative valuation focuses on a price ratio, right? For example, price to earnings, price to sales, price to book value. So long as they are mentioning the word price, we know that this will automatically be a minority model, right? And therefore, if it's a minority model, it's designed to value an interest of 50% and less. So always make sure that if you're using a relative valuation and you're using a price multiple, and again, we'll cover this in detail later, but if you're using a price multiple, the outcome of what you're getting should be to value a minority model. And ultimately, you'll then get straight value, right? So if you perform a relative valuation and using a price to sales, a price to book, a price to earnings, the outcome of that will be the equity value of a company, and it's designed to determine a minority model, i.e., when you have less than 50% of shares in a company. What other instances where we might have a minority model, right? The next one is a dividend growth model, right? If I'm using a dividend growth model, if you recall, you're taking your dividends and you're discounting them at cost of equity. Of course, the cash flow, in this case, it's dividend related, it then becomes a minority model. Therefore, because it's a minority model, right, it's designed to then value an interest of 50% or less. The outcome again of that will be equity value. So all we mean by this is that if I use the dividend growth model and I determine that the value of a company, for example, is 1 million, right? That 1 million represents the equity value of a company. I don't have to do any more adjustments. As you recall, owning equity equals assets minus liabilities. Right? So therefore, if I want to determine the value of a company, i.e., the ordinary equity, if I perform a dividend growth model valuation, the outcome of that valuation will be the equity value already or the company value. No other adjustments are required. The same applies if I perform a relative valuation and I'm using a price multiple. Outcome of that will be equity value. Therefore, I don't need to do any adjustments, right? So these are some of the minority interest models, right? Cool. Now, what would be examples of majority models? Now, majority models are, are typically used to value an interest of 50% or more. So that's what we use majority models for. Now, majority models are typically used to value the company where we're trying to determine an interest of 50% or more, right? I.e., a controlling interest in a company. Now, what are the key drivers of shareholders that have a majority stake, right? If I'm a shareholder and have a majority stake, the main focus of shareholders that have a majority stake are the operating cash flows of a company. Now, why would a majority shareholder focus on operating cash flows? Because they're able to influence them. Because you're a majority shareholder, it typically means you have more than 50% shares in a company. Therefore, you can drive the sales strategy, you can drive the growth strategy, you can drive how we want to approach customers, how we want to price the products. Because you have more control of the company, you are therefore able to influence the operating cash flows. Naturally, then, when valuing a company as a majority holder, you want to use a model that factors in operating cash flows, right? As opposed to a minority holder, as we covered in the previous section, minority holders can't control operating cash flows, so they're only worried about dividends. So that's why, from a majority model point of view, you must therefore incorporate operating cash flows. You can influence them. So, what are examples of the models that are majority models, right? That's it. The free cash flow to the firm and free cash flow to equity are examples of majority models or models that are used in order to value a majority stake, right? So the outcome of the free cash flow to the firm will tend to be the firm value, right? So you still have to subtract here the liabilities at fair value in order to get the ordinary equity. Whereas if you're using a free cash flow to the firm, because you are incorporating finance and cash flows in your cash flows, the outcome of this will be equity directly. So whatever you get here will be from free cash flow from ordinary equity. However, it's also designed to value a majority stake. Why? Because your starting point is operating cash flows or net operating profit after tax. Then you subtract your financing cash flows. Then you subtract your changes in working capital and your capital expenditure. Then whatever you get there by discounting the cost of equity will be your value of your ordinary equity. All right. And another one that I want us to cover is relative valuations. However, relative valuations that use enterprise value multiples. So whenever you're conducting a relative valuation and the ratio I'm using is enterprise value to sales, enterprise value to book, enterprise value to market, um, enterprise value to book, enterprise value to sales, enterprise value to EBIT. So long as there's an enterprise value multiple, then that is also what we call a majority stake because the outcome of that valuation is the enterprise value. So another word for the enterprise value is firm value, right? Or value of the assets at fair value. So if your value of the assets at fair value or your enterprise value or your firm value, then again, you'll have to subtract the liabilities at fair value, then you'll get your ordinary equity. Cool. So these are examples of majority models. Hopefully at this stage, you'll have a better understanding of what minority model is and majority models are. Now, let's look at a more practical application. Now that we understand what minority models are and what majority models are, how do we then link these concepts in a test and exam, right? So let's assume that let's assume that you've got a question and the question asks you to determine the value of a 30% stake in A Limited, right? And assuming again that you've conducted a valuation using price multiple. In this case, we'll call it price to book. So you use the price to book ratio, the same as a relative valuation, right? This is a relative valuation using a price multiple. And the answer you get there is 100 million. Now, this 100 million, right, that you get after doing a price multiple, and they want you to value a 30% stake in a company. In this case, am I happy with this model? And the answer is yes. Why am I happy with this model, right? Remember, when you're looking at a relative valuation and you've used the price multiple, right? It's designed to determine a minority interest, right? So I've used a minority interest model, and the question asks for a 30% stake. Remember, it's less than 50%. So the question is also asking for a minority interest. So therefore, there's a matching here that's happening between the model I used, minority model, and the interest that is required in the question, a minority interest. Therefore, because there's matching, right, there's no adjustment required. Therefore, the 100 million equals the equity value. Remember what we covered there is that when you're using a minority model, a relative valuation, the outcome of that price model, the price multiple is the equity value. So if you recall, the equity value or the value of the ordinary equity is equal to the company value. So therefore, A Limited, right, 100% stake should be equal to 100 million. So if I want to determine a 30% stake, that will be the same as saying 100 times 30. Therefore, my answer should be 30 million. Happy. Okay, cool. So this is a broad outline. Now, happy, easy question, we can do that. But now what would have happened, same scenario, but now we used an enterprise value multiple. So let's look at that. So same scenario, we've got A Limited again. And the question still requires us to determine a 30% interest in the company. So we're still required to determine a 30% interest in the company, the value of it. But now the model we've used, again, it's a relative valuation, but now we've used an enterprise value multiple. Because we've used an enterprise value multiple, and the answer we're getting here is 150 million. We're also told that the value of my liabilities, fair value, is equal to 100 million. Now, how would I go about doing this valuation? Right? Remember the question asks for the company value of A Limited for a 30% stake, right? So as you can see, the question is asking for a minority, asking for a minority interest. But what are we using here? Remember, an enterprise value multiple, right, is a majority model, right? So we've got a mismatch here. We've used a majority model. However, the question is asking for a minority model. So there's no matching that's happening different. So we'll look at what we must do to correct this because ultimately we need to correct this mismatch. Right? So before we start correcting it, we first need to understand that we've determined that the value of the company using an enterprise value approach is 150. That means the enterprise value of the company, which is also equal to the assets fair value, is equal to 150 million. Right. Now, in order to get my equity value, remember we want my equity value, owner's equity. It's equal to assets fair value minus liabilities fair value, which will also give me my company value. So if I want to determine the value of A limited, I must then take 150 million, which is the assets fair value, and I must then subtract the value of my liabilities, which is 100 million. Then the answer I get there is the 50 million. Right. Now, this 50 million that we get here is basically the ordinary equity of the company. That's the ordinary equity of the company. Now, the question asked for a 30% stake. So I'd have to take the 50% and then I'd have to multiply this by 30%. Right? It's 15 million. Now, 15 million is the value of the 30% interest. However, what did we say here? The issue we have here is that we've got that's right, we're using a majority model to value a minority interest. So before we even get there, right, what we needed to have done is to firstly establish our discount, right? So in this case, because the value of 50 million assumes a majority interest, we must then, before even applying this ratio, we need to incorporate a minority discount, right? So how would you go about determining a minority discount, right? So just to sidetrack, a minority discount is basically counting the fact that I've used a majority model, but I'm trying to value a minority interest. Therefore, there's possible overestimation because this model is not designed to value a minority interest. So therefore, I need to give the value of the company a haircut, a sort of a haircut to account for the possible overestimation of the model. So in this case, assuming a hypothetical scenario, we would have expected that 50 million would have been the value of a 50% up interest, but we're trying to get 30%. So what we could do is to say from that 50 million, take 20% times 50 million. And if we take the 20% times 50 million, we're then going to get 10 million. Therefore, that 10 million, that 10 million is effectively the discount. So What we should have done instead of this, right, in this case, what we should have done is basically then say, because of the fact that I'm using majority model to value a minority interest, right, the equity value of the company is 50 million, right? And the 50 million is what I've determined by basically taking the firm value minus the liabilities of 50 million. However, now, because of the fact that I'm using a majority model that is designed to value a majority interest, but I want to determine a minority interest, I must then say less minority discount. Now, in a test and exam, what you determine from a minority discount is judgment. But like what we did here, logically, we know that we want to go from 30% to 50%. So we gave a 20% cut. So in this case, our minority discount is 10 million. So then the value of equity is actually 40 million. This is the value of ordinary equity. Therefore, my stake will then be equal to 40 million and not the 50 million times 30%, which is equal to the 12 million. 12 million. Okay. So this is a very important concept. Now we've established that if you're using a majority model to value minority interest, the outcome, once you get equity value, always remember to subtract the minority discount. And the minority, once you subtract the minority discount, only then can you then determine the true equity value. So in our case, the value was 50 million, but then we realized that we're using a majority model to value minority interest. So we subtracted the minority discount, and then the true equity value was actually 40 million. And therefore, we then got the 12 million. So instead of the 15 million, as you can see, if we didn't have a minority interest or a minority discount, the value of the company would have been the 50 million times the 30, right? Which would have given us 15 million. So we would have overestimated our value. However, once we incorporate the minority discount, we then actually determine that the value is actually 12 million, not 15 million. So very important concept to always remember when dealing with this. And hopefully this has emphasized to you why it was important for us to establish the difference between minority models and majority models. Now let's look at a different scenario, same entity, right? But now let's say the question is A limited, but now they want us to determine the value of a 60% interest, right? And assume that the model I've used is the dividend growth model, right? And the answer I get from the dividend growth model is 120 million. So they want us to determine the company value here. So what should we do here? Right. First and foremost, what you understand is that the question is asking for a majority stake. However, as you recalled, the dividend growth model focuses on dividends, and dividends is a cash flow that minority holders focus on. So therefore, we've used the minority model. Now there's a mismatch here in that the question is asking for a majority model, but we've used a minority model. So we need to then adjust for this mismatch. Right. We'll talk about it now. So first, before we make the adjustment, we know that we want to determine the value of the company, right? So in this case, we're told that the dividend growth model gave us 120 million. This is also equal to the company value. Why? The outcome of using the dividend growth model is equity. So usually the outcome of the dividend growth model is equity. Because we already have equity, remember, it's also equal to the company value. So the company value is 120 million. However, as we've established here, is that this 120 million, which is the company value, is before or assuming that we're valuing a minority interest. Because the model is designed to value a minority interest. The dividend growth model is designed for minority stake. However, we want a majority stake. So therefore, we need to add a control premium. A control premium is the adjustment that we add to the outcome of a minority model to factor in the possibility that there could be underestimation because that model is not designed to value majority interest. So therefore, in our case, if we assume that, hypothetically speaking, this is for interest of 50%, right? Therefore, we're 10% above. So we possibly want to add a control premium of 10% so that we move from 50% to 60%, right? So all we do here, we say 120 times 10%, which will equal, or we should equal 12. Therefore, my value of the company will equal 120 million plus the control premium of 12. Therefore, the true equity value then is 132 million. Therefore, if I want to get my stake now as A Limited or the value of A Limited or 60% stake, I then take the 132 million times the 60%, which is equal to 79.2. Okay, so that is what we call the control premium. So again, as you can see, from a valuation point of view, it's very important to firstly understand of what the model is giving you. Is the model giving you equity? Is the model giving you enterprise value? The model is giving you equity, right? That's the same as the company value, right? So you're fine then. However, if the company is giving you enterprise value, you also need to deduct the value of your liabilities in order to get to equity value. What's the first consideration that you must always consider when doing a valuation? The second consideration is matching the model with the question. So if I'm using a majority model, I need to value a majority interest. If I'm using a minority model, I need to value a minority interest. Where there's a difference between the model you are using, what you're trying to get, then you either have a minority discount or a control premium. Minority discount occurs when use a majority model, right? And remember, we have some of the majority models, free cash flow to the firm, free cash flow equity, or a relative valuation that uses the enterprise value multiple. So when you get a majority model, you try to get a minority interest. Once you get your equity value, always remember to add a minority discount or subtract a minority discount before determining the value of that company. That's what we do there. What if you then ask to determine a majority stake by using a minority interest? And then in this case, a minority model would be, for example, using a dividend growth model or using a relative valuation where you're using a price multiple. The outcome of that would be equity. However, that equity is underestimated because it's designed for a minority model. Therefore, you have to add a control premium in order to get the correct equity value for the company. Now, this brings us to the end of this session. Hopefully, after you've answered or looked at this video, you're in a better position to understand how valuations occur. So, what have we covered in today's session? Right? We've covered the fundamentals of a valuation. We've understood that a valuation occurs because of the fact that we're trying to make a decision. There are two main decisions that investors, or typically we see in a test and exam. The first decision is the investment decision, whether we should buy or sell. So we perform a valuation to determine what the value of the company is so that we're in a better position to determine whether we should buy or sell that interest. We also do valuations in order to determine the correct price to pay. This is a specific integration with mergers and acquisition. If you understand the value of a company, then you know at a minimum what the price you should get as a seller in order to compensate you for that company. Then we looked at the different types of valuation models. in the dividend growth model, free cash flow to the firm, equity, as well as relative valuations. We then looked at what the outcome of each valuation model is. For example, we looked at if you do a dividend growth model, the outcome of that is equity. If you do a relative valuation, if you're using a price multiple, the outcome is equity. If you use enterprise value, the outcome is enterprise value. If we're using, therefore, if you're using an enterprise value multiple, you then have to deduct your liabilities first in order to get equity value. The same concept applied when we looked at income approaches to valuations. We said if you're using the dividend growth model, the outcome of that is equity value. However, if you're using the free cash flow to the firm model, the outcome of that is enterprise value. You still need to subtract your liabilities at fair value to get equity value. Free cash flow to the equity is also a majority model. However, the nice thing about that model is the fact that you already incorporate financing cash flows within the model. So therefore, the outcome is automatically equity in that case. Then lastly, we looked at the concept of a control premium minority discount, which occurs when there's a mismatch between the interest you're trying to value and the model you're using. Thank you for listening to this video, and hopefully you're in a better position to understand valuations after listening to this. Please watch out for our part two, where we take a deeper dive into the valuation models and how you can actually apply them in test and exams. Until we meet again, remember to like, share, comment, and see you again in part two. Thank you.